Federal Reserve Governor Christopher Waller has indicated that the central bank might consider lowering interest rates as early as July, following the Federal Open Market Committee's FOMC decision to maintain the current rate of 4.25% to 4.5%. Waller's remarks suggest a proactive approach to monetary policy, aiming to manage inflationary pressures and preempt a potential slowdown in the labor market. Despite recent votes to hold rates steady, Waller noted that inflation is no longer a significant threat. Supporting the rationale for easing monetary policy, the FOMC's dot plot reveals a divided outlook among policymakers, with some members advocating for steady rates and others, including Waller, open to potential cuts. This division underscores uncertainty about the economic outlook, particularly regarding inflation trends and labor market vulnerabilities. While President Donald Trump continues to pressure the Fed to lower rates significantly to address the $36 trillion national debt, Waller suggests a cautious approach with gradual rate reductions to avoid economic disruptions. The central bank's median projection anticipates 2 rate cuts by the end of 2025, though 7 members oppose any cuts this year. Market participants and investors are closely monitoring the Fed's actions, as rate decisions could impact financial markets, including stock performance and bond yields. While market expectations currently indicate a low probability of a rate cut in the upcoming July meeting, potential adjustments are anticipated in September.
The U.S. Supreme Court has declined to expedite a legal challenge against tariffs imposed by former President Donald Trump, granting the Trump administration additional time to respond to the lawsuit. The challenge was brought forth by 2 toy companies, Learning Resources and Hand2Mind, who argue that Trump exceeded his authority under the International Emergency Economic Powers Act, IEEPA, by implementing tariffs without congressional approval. This decision allows the administration a standard 30-day period to file a formal response, delaying a resolution to the dispute that has significant implications for businesses affected by these tariffs. The core of the legal argument centers on the interpretation of the IEEPA, a law enacted in 1977, which the toy companies claim does not empower the president to unilaterally impose broad import duties. Previously, the U.S. Court of International Trade had temporarily blocked these tariffs, but a federal appeals court permitted them to remain in effect pending further hearings. The outcome of this case could have wide-reaching consequences for trade policy and presidential powers, potentially impacting market stability and business operations across various sectors reliant on imported goods. As the legal proceedings continue, affected companies and investors are closely monitoring the situation for any shifts in trade policy that could influence market conditions.
Bank deposits in the country have surged to a record high following a decline in key interest rates, as reported by 24 News HD. The total banking deposits reached an increase of 11.6% in May 2025, equating to a rise of 3,408 billion rupees year-on-year, and an additional 441 billion rupees compared to the previous month. This growth is largely attributed to the reduction in interest rates, which has incentivized depositors by offering better returns on their savings. The increase in deposits signifies a shift in consumer behavior towards saving, likely influenced by the recent monetary policy adjustments aimed at stimulating economic growth. With the central bank's decision to lower rates, individuals and businesses are finding it more attractive to park their funds in banks, potentially leading to increased liquidity within the financial system. This trend could have broader economic implications, potentially enhancing banks' capacity to lend and supporting economic expansion efforts.
Escalating tensions in the Middle East, particularly following Israel's recent attacks on Iran, have reignited interest in the oil market, highlighting the Direxion's oil-focused ETFs, GUSH and DRIP. The strategic importance of the Strait of Hormuz, through which a significant portion of the world's oil is transported, has raised concerns about potential disruptions to global oil flows. With the possibility of Iranian oil infrastructure being affected, analysts warn that Brent crude prices could spike, potentially reaching triple digits if the conflict escalates further. This geopolitical backdrop is compounded by the Federal Reserve's steady interest rates amidst inflation concerns, which could lead to a more accommodative monetary stance stance, further influencing oil prices. Direxion's ETFs offer traders a means to speculate on these market movements. The GUSH ETF, designed to provide 200% of the daily performance of the S&P Oil and Gas Exploration and Production Select Industry Index, has gained over 15% in the past month due to the geopolitical crisis, despite an 8% loss year to date. Conversely, the DRIP ETF, which seeks 200% of the inverse performance of the same index, has seen a 19% decline year to date. While these ETFs provide a straightforward mechanism for speculation, they come with significant risks, including high volatility and the potential for positional decay if held beyond the intended one-day exposure. Investors are advised to approach these leveraged and inverse ETFs with caution, considering their complex nature and the current volatile market conditions.
Ether ETFs have experienced a resurgence in inflows, driven by increased institutional interest and regulatory advancements in the U.S. regarding stablecoins, many of which operate on the Ethereum network. This renewed attention follows the successful IPO of Circle, the issuer of the second-largest stablecoin, and changes in leadership at the Ethereum Foundation. Despite the positive trend in ETF inflows, the price of Ether remains flat for the past month, and has declined 25% year-to-date, impacted by market volatility and competitive pressures from platforms like Solana. Institutional investors are recalibrating their strategies, focusing on long-term infrastructure bets rather than short-term price momentum. The Ether futures market presents arbitrage opportunities. As the CME basis, the price difference between futures and spot prices, is currently higher for Ether than for Bitcoin. This has attracted investors to Ether ETFs, contributing to a consistent inflow pattern. While the market remains volatile, the conviction among institutional investors suggests a strategic positioning for potential future utility unlocks, such as staking access and options listings, which could further bolster Ether's role in the financial ecosystem.
The latest developments in AI-driven healthcare tools are reshaping investment strategies, with companies like Avant Technologies, Inc., OTCQB, AVAI, Spectral AI, Inc., NASDAQ, MDAI, and Palantir Technologies, NASDAQ, PLTR, at the forefront. Avant Technologies, in collaboration with Inovatech, has launched Vision AI, a non-invasive retinal scanning service aimed at early detection of diabetic retinopathy, now available in Costa Rica, Nicaragua, and Panama, with plans to expand into Mexico. This strategic rollout is part of Avant's broader vision to integrate healthcare delivery by merging with Inovatech, consolidating leadership and technology under a single entity, and streamlining operations ahead of potential FDA discussions. The AI healthcare sector is experiencing a surge in venture capital interest, with AI firms accounting for over half of digital health funding in Q1 2025. This influx is fueling innovations like Spectral AI's DeepView system, which enhances burn treatment assessments, and Palantir's partnership with teletracking technologies to optimize hospital operations. These advancements not only promise improved patient outcomes, but also present lucrative opportunities for investors, as companies leverage AI to drive efficiency and expand their market presence in the healthcare industry. As these technologies gain traction, they are poised to transform healthcare delivery, offering scalable solutions that could significantly impact both patient care and financial performance.
Core financial event. Internet Computer (ICP) has achieved a significant milestone by enabling native decentralized access to the Solana Sol blockchain, allowing seamless interaction across multiple blockchain networks without relying on centralized servers. Key entities. The main entities involved are Internet Computer (ICP), Solana Sol, Bitcoin BTC, Ethereum, and the Network Nervous System DAO. Additionally, this advancement aligns with Helium's roadmap and involves various developers and decentralized applications (dApps). Context and impact. This development allows ICP to facilitate cross-chain transactions and interactions, such as swapping Sol for BTC or managing NFTs directly from its network. By integrating with Solana, ICP enhances its functionality, enabling developers to build multi-chain dApps that operate seamlessly across different blockchains. This could significantly reduce the complexity and cost associated with maintaining multiple nodes and dealing with rate limits. For users, it promises a more integrated and efficient experience, such as one-click cryptocurrency trades without the need for intermediary bridges. The move positions ICP as a more versatile platform, potentially increasing its adoption and relevance in the rapidly evolving blockchain ecosystem.
Japan is grappling with a dramatic surge in rice prices, which have more than doubled over the past year, marking the steepest increase in 5 decades. This price hike is attributed to several factors, including climate change-induced heat waves that have reduced crop yields, widespread pest damage, and panic buying triggered by an earthquake warning. The situation is further exacerbated by a global wheat shortage, spurred by the ongoing Russia-Ukraine conflict, which has driven consumers to seek rice as an alternative, increasing demand. Additionally, rising fertilizer costs have placed further strain on Japanese farmers, who predominantly operate on small-scale farms, revealing structural vulnerabilities in the nation's agricultural system. The economic implications of Japan's rice crisis are profound, with significant political ramifications as elections approach. The surge in rice prices is adding to broader inflationary pressures in Japan, where the core inflation rate reached 3.7% in May, the highest since January 2023. This inflationary environment is particularly burdensome for Japanese households, many of which have seen their purchasing power eroded. The crisis has led to increased reliance on imported rice, challenging Japan's food self-sufficiency and the sustainability of its protected agricultural market. As public discontent grows, Prime Minister Ishiba's administration faces mounting pressure to address the crisis, which could impact voter trust and influence the upcoming elections. The government is exploring market interventions and long-term agricultural reforms to stabilize prices and ensure food security, but immediate solutions remain elusive.
Accenture plc's stock experienced a decline following its Q3 2025 financial results, despite surpassing earnings expectations. The company reported earnings of $3.49 per share, exceeding the analyst consensus of $3.31, with revenues reaching $17.7 billion, slightly above the anticipated $17.30 billion. Sales showed an 8% increase in US dollars and 7% in local currency. Notably, the consulting and managed services segments saw growth, with revenues of $9.01 billion and $8.72 billion, respectively. However, new bookings fell by 6% in US dollars and 7% in local currency, totaling $19.7 billion for the quarter. Accenture is undertaking a strategic overhaul, emphasizing artificial intelligence, and plans to launch a new reinvention services unit on September 1, 2025. This restructuring includes leadership changes, with Manish Sharma transitioning to Chief Services Officer and John Walsh becoming CEO of the Americas. Despite the dip in new bookings, Accenture raised its fiscal year 2025 revenue growth outlook to 6% to 7% in local currency and adjusted its earnings forecast to $12.77 to $12.89 per share, slightly above the consensus of $12.75. The company's strategic focus on AI and leadership realignment could potentially position it for future growth, though the immediate market reaction was negative, with shares trading 5.19% lower pre-market.
Darden Restaurants has revised its annual same-store sales forecast upwards, following a robust quarterly performance driven by increased demand in its casual dining segment, notably through Olive Garden. The company reported a 4.6% rise in consolidated same-store sales for the quarter, with Olive Garden alone seeing a 6.9% increase. This growth is attributed to strategic initiatives like enhanced food delivery services, including partnerships with Uber Direct and promotional offerings such as buy one, take one deals. Darden's efforts to innovate its menu and boost advertising have successfully attracted customers, countering the trend of consumers opting for home-cooked meals to cut costs. Consequently, Darden's shares rose approximately 3% in pre-market trading, further buoyed by the announcement of a new $1 billion share repurchase program. In contrast, fast food chains like McDonald's, Starbucks, and Domino's Pizza are grappling with weakened demand, highlighting a shift in consumer preferences towards casual dining experiences. Darden's revised same-store sales growth projection of 2% to 3.5% surpasses the analyst consensus of 2.64%, as per LSEG data. Despite slightly missing earnings per share forecasts, with a range of $10.50 to $10.70 against an expected $10.75, Darden's quarterly revenue of $3.27 billion exceeded estimates, driven by moderate price increases and reduced input costs. This performance underscores the company's resilience and strategic acumen in navigating a challenging economic landscape, setting a positive tone for its future outlook in the competitive restaurant industry.